Hello and good evening, everybody. Thank you very much for coming, and thank you very much to AJ Bell for organising the evening. I'm Matt Bennison. I work in UK Equities at Schroders, and as mentioned, I'm one of the fund managers on the Income Growth Investment Trust, which I'll talk mainly about later, because to start with, I'm going to talk about UK equities, the issues affecting them, why we think they're attractive, and then how we're incorporating that into our portfolio today. But when we talk about the UK equity market, I'm going to start with a reminder that despite being called UK, what these two are up to is actually one of the biggest drivers of our day-to-day moves in markets at the moment. The rhetoric around trade wars and the knock-on effect of that on global monetary policy and interest rates. And the reason for that is that 73% of the revenues of companies listed on the UK equity market are actually generated overseas, not on these shores. And it's only 27% of those that are generated overseas. You know, there's a lot of global companies in the market: Royal Dutch Shell, Unilever, Diageo, the global drinks brands that I'm sure all of you are aware of. So that's why these global issues affect us. But for the other 27%, there is also something going on that you might have seen and heard about, called this. And whether you're Freddie Mercury, who just wants to break free, you're Thelma Houston, who doesn't want to leave this way, or whether you're Joe Strummer, who just still can't decide after all these years whether he should stay or he should go, something's going to happen. And there's a great deal of uncertainty still around what's going to happen. And that is affecting the sentiment of the international investment community towards UK assets. So how do we gauge the sentiment towards the UK market and UK assets? Well, the simplest and one of the most effective ways that we use to do this is just to look at the currency. Now, this chart here was put together by our economists at Schroders, who went around and surveyed a load of other economists and market participants and asked them what they thought would happen to sterling versus dollar in the event that there was either a no-deal Brexit or that there was some kind of withdrawal agreement. And their general opinion was that, in the case of a no-deal Brexit, sterling would weaken and go towards kind of $1.10, what was 110 to the dollar, and in the event of some kind of withdrawal agreement, we might be back to 135. So, where we were on Monday, which is broadly where we are today, around 124, is showing that the market's kind of thinking we're in the Joe Strummer middle ground. We're in the Strummerville. We can't really decide where we're going to end up yet. But more relevant to our day-to-day job of investing in UK equities, let's have a look at the sentiment of the international investment community towards the UK equity market. Well, they're not thinking a lot. So what's this chart showing? This, again, is another survey that Bank of America Merrill Lynch do every month of market participants, asking them what their asset allocation is. And you can see since the 23rd of June 2016, everyone's been rock bottom on their allocation to UK equities. No one's been buying, and a lot of people have been selling. And you can pick up a paper, have a Google, read the Financial Times to work out the billions and trillions that have left the UK equity market in this time. So it's been languishing at the bottom of this chart for 3 years now. So what does this mean for the valuation of the market? Well, we'll go back one. It means that the UK, right at the bottom of this chart, on a valuation basis, like a price-earnings multiple we often use to determine the valuation of stock markets, is on a 10-year basis the cheapest it has been relative to pretty much all other global markets. And there's a lot of academic evidence out there to suggest that the price you pay for your investment, i.e. the valuation, is the most important factor in determining your subsequent 5 or 10-year return. And now I'm not going to use a horse's analogy, but I'm going to use an analogy that I might be at the wrong section of the M62 for, because the kind of investment approach that we're looking for here is what I'd like to call the Jrgen Klopp investment approach, which is, you're looking to buy the Andrew Robertsons of the world, for £8 million left from Hull City, and watch them develop to become football players that are worth tens of millions of pounds. You're not looking to buy the Paul Pogbas of the world for 90 million and watch them subsequently fall back over the subsequent years. My apologies to the majority of the audience that I've probably just alienated with that analogy. So what gives us more confidence in the attractions of the UK equity market is the fact that in the last 2 years, we've seen a great deal of M&A activity. So whereas the investment community has been shunning our market on our assets and not investing in it, trade buyers coming from abroad and private buyers have been, hoovering up our companies. There's been a lot of examples of that in recent weeks. We've seen Hong Kong bid for the London Stock Exchange. We've seen the fact that the Chinese love the Great British Pub. We've seen Hasbro buy Entertainment One, that was listed on the stock market, the owner of the great asset that is Peppa Pig. We've seen Merlin Entertainments bought this year, the owners of Alton Towers, but also brands such as Madame Tussauds. These are global brands that you can roll out across the world. It's because it goes back to the point made originally that, that we've got to remember that whereas the stock market is languishing at the bottom on a valuation basis, it's a very international market that's full of kind of international franchises. But saying that, because of the sentiment towards the market, in particular UK assets, we found the most interesting hunting ground in our portfolios over the last 18 months have been in this area, in UK domestic stocks and shares, for the simple reason that we believe that uncertainty creates opportunity. Now, we have to be very selective about those opportunities because there's a lot of risks around some of these companies that we invest in. If it's a retailer, domestic retailer, there's a lot of disruption in the world from technology. A lot of pub companies have a lot of debt, and the strength of the balance sheet of a company is something that we spend a lot of time thinking about because that impacts their cash flows and their ability to invest in their own business. But to demonstrate how we've been trying to increase our exposure to some of these selective domestic opportunities, what this slide shows is the green line is the domestic revenue exposure of the UK stock market. It's the number that I was talking about before. Around a quarter of the market's revenues are generated domestically on these shores. So what we've been doing in our portfolio over the last year is increasing the blue line shows our exposure to these domestic companies or domestic revenues. We've been increasing this as a percentage of our portfolio by buying companies like Tesco, where we believe under the management of Dave Lewis, who spent a lot of his career at Unilever, he's done a good job with the turnaround. The balance sheet is stronger. They've integrated Booker well, and they're now generating good cash flow. Whitbread, the owner of Premier Inn, who sold Costa Coffee to Coca-Cola for £4 billion last year. We believe that this gives them the optionality to invest in Premier Inn and roll that out in Germany, which is a market which has a much lower percentage of branded hotels. Crest Nicholson is a house builder, and everyone will be familiar, the majority of people will be familiar with Pets at Home, which is half a pet retailer, and the other half of the business is a franchise model where they have a business called Vets for Pets, where they provide the back office and financial services and branding for vets. Because if you are a vet, typically you are a quite scientific individual that perhaps isn't as business-minded as some others. So you would like a lot of support on that side of things to put a business plan together for you. And this is exactly what Pets at Home do, and they take a clip of the vet's revenues each year for that. And pets are a growth market and a very resilient market as well. It was one of the few things in retail where spend did not decline in 2009. It carried on growing, and spend on people's pets, I'm sure a lot of people in this room are aware, is growing at mid-single digits. So that's one of the reasons that we see attractions in Pets at Home. But as I've discussed earlier, we also have to be conscious of the fact that there are 3/4 of our market's earnings come from overseas, and there's a great deal of attractive global franchises listed in the UK market, many of which trade at a discount because of the uncertainty around our market to their global peers. So if we took the competitors of Johnson Matthey make catalysts for automobiles predominantly. So they're 65% of the catalysts that will be cleaning up the rubbish that comes out of the back of your diesel car in Europe is made by these guys. And they have a big opportunity as regulation tightens in China and India to make the most of growth there. And they trade at a discount to their international peers. The luxury goods brand Burberry with a great Far Eastern sales opportunity. The security brand G4S and the international education company Pearson, who generate the majority of their sales from the sale of textbooks and digital education equipment to universities in the US. Now, I'm conscious that I'm here to talk about our income growth investment trust, so let's have a quick look at the income characteristics of the UK market. Well, I think quite like this chart because it shows that the income characteristics of the UK market have perhaps through this lens not been this attractive for 80 years. So what this is showing is the dividend yield of the UK stock market minus the UK government bond yield. So it shows that we're at a 3% or 300 basis point, in technical terms, premium to the bond yield, i.e. the dividend yield of the UK market at 4.3% is much more attractive than the government bond yield of the UK at 1% for income-conscious investors. So how do we approach this when we're thinking about constructing an income portfolio? Well, our approach is what we like to call a barbell approach, where around half the stocks in our portfolio come from steady, cash-generative, slightly lower growth companies that you see on the right-hand side of the chart. And then the other material portion of the portfolio comes from so over here, the dividend yields will be over 4.9% in most cases, 5 and into the 7 and 8% in some cases. And on this side, less than 3.9%. Some go into the 2% yields. But the important thing about this bucket is that they're growing. They're growing their yield at mid to high single digits, because one of the overarching objectives of our investment trust is not only to provide an income, but it's also to provide an income stream that grows through cycle ahead of inflation. So let's have a look if we have at how we've delivered this historically. This is one slide that we're quite proud of in the trust in general, and what has given us what's called AIC dividend hero status, that for 23 years the trust has delivered an unbroken record of dividend growth, and the average of that is 4.6%, which is materially ahead of inflation. So we have and continue to do what we say on the tin. So we hope that as I mentioned, the 4.3% yield today, growing at mid-single digits with some capital growth, is a relatively attractive proposition. And on that bombshell, I will hand back to Roland. Thank you very much.
Matt, thank you very much.